Hello again, everyone. It is about 9:30 in the morning Chicago time on Wednesday, May the 11th, 2022. I'm John Kosar of Asbury Research and Asbury Investment Management, and this is your Daily 5. These are currently my 5 most important charts, data series, and quantitative models that I think are going to be the most influential to U.S. stock market direction looking ahead over the next several weeks or more. Let's begin. Number 1, market internals. The Asbury 6 remains negative. The Asbury 6 is our in-house, it's one of 2 in-house tactical models that we built to show us what the internal condition of the market is. The other one is the correction protection model. The Asbury 6 was developed maybe about 5 years ago because the character of the market has changed. It used to be where you could just look at the S&P 500, maybe look at some volume, and get a pretty good back of the envelope idea of what the market was doing or what investors were thinking. That's no longer the case. Last Thursday, the market was up 130 points after Powell spoke. The next day, it was down 130. It makes investors nervous. And when investors are nervous, they start to make mistakes. So what we did was we built a model that would take a look underneath the hood of the market and tell us what is really going on. I think a lot of the day-to-day that we see now has to do with algorithmic trading. That's where most of the volume is day-to-day. And I think a lot of these models are out to do some financial jiu-jitsu on us. They get us to bite on moves, and as soon as we do, it takes it right back, and now we're chasing our tail and going the other way. So what we did here is we took the best tactical indicators that I know of in my 40-year career, and we started to backtest them to see which ones worked well in terms of offsetting others. No indicator is right all the time. There is no such thing as a favorite indicator for me because they all have their Achilles heel. So what we did is we found 6 that are really good at telling you what the overall condition of the market is on a very tactical near-term basis, and they're different enough from each other where if 1 or 2 indicators fail, they hit their Achilles heel, the other ones will pick them up. So we've got 6 indicators here. Only one of them, the rate of change in the S&P 500, has to do with the S&P 500. And again, we did that on purpose because we wanted to avoid getting sucked in by these up and down crazy moves day to day in the S&P 500. So we've got stuff like relative performance of stocks versus bonds and market breadth and asset flows and trading volume. So when I was with you last was April 13th, almost exactly a month ago. One of the first things I told you is that the A6, the Asbury 6, had just turned to negative as of April 12th. Since then, the S&P 500 has dropped by 500 points, or about 11%. And the takeaway here is we're still negative. 4 of these or more would have to turn back to green or positive in order to tell us that the internal conditions of the market have improved to the point where we could start buying again. We could start putting new money to work. That is not the case. You can see so far this year, January 14th, the A6 went to risk off. It went back to risk on St. Patty's Day here, March 17th, and then again back to risk off on April 12th, and we're making fresh lows. So this is telling us the market is still internally weak, and to be very careful that you're not going to be faked into taking a big shot at picking the bottom in the market when the internals are not strong enough to support it. Number 2, know your levels. S&P 500 is hitting the speed bumps. When the market's falling this hard, I look at these support levels as speed bumps. And until the Asbury 6 tells me that the market's strong enough to actually hold one of those support levels and start a new move higher from it, they're just speed bumps to me. So here we are. This is the S&P 500 going back to the beginning of last year, and you can see right now the market is negotiating this, or I should say the S&P 500 is negotiating this 39.84 to 39.50 area. I'm circling it here. That is the lows from February and March of last year. If we break through there, the next big level, as I see it, is the March 4 low of last year, and that's all the way down at 37.23. On the top side, the current tactical downtrend is going to remain valid below 42.79 to 43.49, which is the OC1 low here, and the 50-day moving average, which is in blue. And the major downtrend is going to remain intact below this 4,500 area up here, which represents the 200-day moving average in orange and also the high from April the 21st. So the bottom line here is there's a lot of room for the market to bounce and still not change any of the prevailing downtrends that we have right now. Number 3, influential stocks. We're watching Tesla right now. It's a very interesting chart pattern. Let's have a look at that. This is Tesla daily going back just about a year. And the first thing to notice is that Tesla's been kind of stuck in neutral here since right before Thanksgiving of last year. But we're now starting to break out of this well-defined investor indecision area. The bottom of that investor indecision is 845.50 per share. We've been underneath it for the past 2 days. This is now a critical resistance level. If this 845, let's call it 846, continues to hold Tesla from going higher, this breakdown is going to look a lot more real to me, and it could hypothetically take Tesla all the way down to 540. And in the meantime, look at the relative performance chart here. We've got the daily relative performance chart, the corresponding chart to the one up here. This is relative performance daily between Tesla and SPY, the S&P 500. You can see that it's starting to break its 63-day moving average here, which indicates that it's starting to roll into a quarterly trend of relative underperformance versus the broad market. That's another big deal to us here. We want to see the breakdown, but we want to see underperformance. We're seeing both of those now. What makes this really important, Tesla is number 5 in market cap. It's the fifth largest stock according to market cap, and it has maintained a very tight and stable and significant 10-year linear correlation with the S&P 500. So that means if Tesla's weak, statistically, it's likely that the entire stock market's going to be weak right along with Tesla. So the more Tesla continues to roll over from this 846 a share area, the more concerned I'm going to be that we've got another large leg lower coming up in the S&P 500. Number 4, the Asbury 6 tells us when to be invested. We also have a number of quantitative models that tell us where to be invested. One of those is our SEAF model. SEAF stands for Sector ETF Asset Flows, and that has been overweight energy since January the 4th. So let's take a look at the latest update on this model. This is updated in our research center on Saturdays. On the weekend, it's updated once per week, and you can see through last week, we'll be updating this again in a couple of days. Through last week, the trends of asset flows have been out of financials, in red here, out of technology, and into energy. So out of financials and tech and into energy. And this trend in energy actually originated on our SEAF model back on January the 4th. Since then, XLE has risen by 36% outright and has outperformed the S&P 500 by 63%. So if you're in the stock market this year and you weren't in energy, you're not doing so well. I mean, energy has been kind of a savior. It's been the one place that has consistently outperformed and has been very strong in terms of the sector space. Again, the latest data also show the resumption of the January 10th trend of outflows from financials and a new trend of outflows from technology. So we are avoiding those two sectors, and we continue to remain overweight energy until this model shows us the money is going elsewhere. We're going to stay overweight energy. Number 5, second quarter seasonality, more pain ahead. I am not a huge follower of seasonality because I think it's a tertiary kind of an indicator. But when I do think it's important is when the seasonality implications, what seasonality is telling us, dovetails with what we're seeing in the market. So right now we're seeing a weak market, we're seeing a weak Asbury 6, we're seeing key stocks starting to roll over. Tesla's one of several. But now take a look at this weekly pattern. This is the the 13 columns represent the 13 weeks of the second quarter. This data goes back to 57, and it goes through last year. Here is May that is kind of bracketed off here. The 3 final weeks of May, which are in the first of those now, and the 3 final weeks of June are the 6 weakest weeks of the entire second quarter. So I look at seasonality as kind of wind at your face or wind at your back. And right now the market is going down, and seasonality is also pushing downward too. I think that could tend to exacerbate a move that we can already see on these current charts. So there you have it. If you like our approach to investing, how we look at markets, I invite you to visit our YouTube page and subscribe. And you could also get more information about us by visiting www.asburyresearch.com. Thanks for listening. Have a great rest of the week, and we'll see you at the next one.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.